Hi, this is Jack Crooks from Money and Markets TV. I'm primarily a currency trader, but I follow all the asset markets, including stocks. And I've noticed that the stock market has been acting very strangely recently. First of all, stock prices are becoming unmoored from underlying fundamentals. In theory, stocks are supposed to trade based on future earnings estimates, but profits at S&P 500 companies in the second quarter are as bad as they've been in 3 years. And the current quarter looks even worse. In addition, the three major drivers of the global economy, the United States, Europe, and China, are slowing down. Yet U.S. stocks keep levitating on hopes that more quantitative easing will boost liquidity and stimulate consumer wealth. However, there's a major flaw in that argument. The consumer wealth effect only works in a normal business environment, and what we're seeing now is anything but normal. This is a balance sheet recession that has a lot in common with some of the worst economic downturns in history. For example, just like the panic years of 1873 and 1929, public debt is soaring. Debt as a percentage of U.S. GDP was actually considered off the charts in those 2 years, but they don't hold a candle to where we are now. What's interesting is that after all these panics, long-term Treasury yields declined to under 2% and remained there for years. In fact, 2 full decades after the panic years, interest rates still average just 2.5%. But I think we have a more recent model that could give us a better idea of what the future holds for U.S. stocks. Japan. The Japanese panic year occurred in 1989, when public and private debt totaled a whopping 540% of GDP. Since then, Japanese stocks had fallen steadily, and almost 25 years later, they're still only worth half of what they were back then. At the same time, the Japanese yen has grown steadily stronger against the US dollar. And I believe we're going to see a similar long-term pattern play out here. Of course, there will be an ebb and flow in stock prices as always, and liquidity dumps by global central banks will cause sharp rallies from time to time. But based on historical precedent, I'm convinced the overall trend will be lower. Similarities, especially to Japan's economic situation, are just too obvious to ignore. Massive fiscal stimulus pushing debt to unsustainable levels, check. No inflation despite those high debt to GDP levels, check. Virtually free money to anyone who wants it and real interest rates below zero, check. And a rising currency thanks to global money flow and institutional retrenchment, check. You might remember Ben Bernanke confidently saying a few years ago that we would never follow down the path of deflation, that the Federal Reserve would be able to create inflation with all those tools at its disposal. Well, Mr. Bernanke, we're still waiting. I'm Jack Crooks from Money and Markets TV. Thanks for watching.